All right, let's talk about something that sounds incredibly boring but secretly runs the world: algorithmic trading. It sounds like a math class you'd happily skip, but it's basically what happens when you give a computer a boatload of cash and tell it to play the stock market. Instead of a person in a pinstripe suit shouting buy sell into a phone, you have a sophisticated algorithm making thousands of trades in the blink of an eye. This isn't just a niche corner of finance anymore. It's the whole casino. These systems are now central to everything, from managing your pension fund to deciding the price of, well, just about anything. And they're getting smarter, faster, and more powerful every single day. The reason Wall Street fell head over heels for these digital day traders is simple: speed and efficiency. A human trader can react in, say, a few seconds if they've had their morning coffee. An algorithm can execute a trade in microseconds. That's a millionth of a second. It's the difference between sending a letter by horse and sending a text message. These systems can analyze mountains of data, news reports, social media trends, economic indicators, and make decisions faster than you can say unregulated capitalism. It's no wonder financial institutions are pouring billions into AI, with spending expected to hit nearly $100 billion by 2027. This isn't the future. It's the hyper-caffeinated, sleep-deprived present. Now, this isn't just about making money faster. The promise of AI in finance is that it can also be used for good things, like detecting fraud or managing risk. Think of it as a digital bloodhound, sniffing out suspicious transactions before they can do any real damage. In theory, these systems can spot patterns that no human ever could, making our financial systems safer and more secure. They can assess credit risk more accurately and even provide personalized financial advice. It all sounds fantastic, like a utopia designed by your incredibly organized and slightly obsessive-compulsive accountant. A world where financial decisions are made with pure, cold, impartial logic. But here's the rub. What happens when that pure, cold, impartial logic isn't so impartial after all? The systems we build are only as good as the data we feed them and the rules we give them. And as we've handed over more and more control to these automated decision makers, we've also started to see the cracks in their digital armor. The very speed and complexity that make them so powerful also make them incredibly dangerous when things go wrong. And oh boy, can things go wrong. The dream of a perfectly rational market run by benevolent robot overlords is starting to look a lot more like a high-stakes gamble with everyone's money on the table. So we've built these incredibly complex financial robots? What could possibly be the problem? Well, for starters, there's the issue of bias. You might think a computer is the epitome of fairness, but an algorithm is like a very obedient, very literal-minded puppy. It only learns what you teach it, and if you train it on historical financial data, which is riddled with decades of human biases, the AI will learn those biases too. It might even amplify them. For example, if an algorithm for approving loans is trained on old data, it might unfairly deny loans to people in certain neighborhoods or from specific backgrounds, not because of malice, but because it's just repeating the patterns it was shown. It's digital discrimination, just with more math. Then there's the black box problem, which is exactly what it sounds like. Many of the most advanced AI models are so complex that even their own creators don't fully understand how they arrive at a particular decision. You put data in one end, and a decision comes out the other. But the process in the middle is a complete mystery. It's like asking a magic 8-ball for financial advice, and it just says signs point to yes. Why? The 8-ball isn't telling, and neither is the algorithm. This lack of transparency is a massive issue. How can you challenge a decision you don't understand? How can regulators ensure the system is fair if nobody can look under the hood? This brings us to the ultimate question. When one of these black box algorithms inevitably messes up and costs people their life savings, who do you blame? Is it the fault of the programmer who wrote the initial code? The financial institution that deployed it? The company that supplied the data? Or do we just shrug and blame the ghost in the machine? This lack of accountability is terrifying. It creates a situation where everyone can point fingers at everyone else, and the algorithm itself can't exactly be put on trial. It's the perfect setup for a corporate pass-the-buck bonanza, leaving ordinary people holding the bag, while the architects of the system claim it was an unforeseeable error. And let's not forget the line between helpful nudging and outright manipulation. These systems know more about us than our own mothers. They can analyze our online behavior, our spending habits, and our emotional state to predict what we'll do next. It's one thing for an AI to suggest a stock you might be interested in, It's another thing entirely for it to exploit your known psychological weaknesses to trick you into making a bad investment. The potential for these systems to be used to manipulate markets and consumers is enormous. We are wading into a murky ethical swamp, armed with little more than a vague hope that the robots will be nice to us. If you want a perfect, terrifying example of what happens when these algorithms go haywire, look no further than the 2010 flash crash. On May 6th of that year, the stock market suddenly went into a nosedive for no apparent reason. In the space of about 36 minutes, the Dow Jones Industrial Average plunged nearly 1,000 points, wiping out almost $1 trillion in value. Then, just as mysteriously, it bounced back. For a brief, heart-stopping moment, it looked like the entire global financial system was about to implode. And the culprit? A cascade of automated trading programs all reacting to each other in a frantic, panicked feedback loop. The flash crash was triggered by a single large sell order, which set off a chain reaction among thousands of high-frequency trading algorithms. These bots, programmed to sell when prices started to drop, all hit the panic button at once. As they sold, prices fell further, which triggered even more selling. It was a digital stampede, with no humans in the loop to calm things down. The event starkly revealed the systemic risk we've introduced into our markets. We've built a system so fast and interconnected that a small glitch can spiral out of control before any human can even figure out what's happening. It's like giving the keys to a Ferrari to a teenager who only knows how to press the accelerator. This wasn't a one-off event. There have been numerous mini-flash crashes and other algorithmic mishaps since then. In 2012, a firm called Knight Capital Group lost over $440 million in 45 minutes because of a software glitch in its trading algorithm. The faulty code caused the system to flood the market with erroneous orders, effectively buying high and selling low at lightning speed. The company was driven to the brink of collapse in less time than it takes to watch an episode of a sitcom. These incidents are a constant reminder that the code running our financial markets is fragile, and the consequences of a single error can be catastrophic. The core issue here is that these systems lack common sense. A human trader might see the market behaving strangely and pause to ask, wait, does this make any sense? An algorithm, on the other hand, will just follow its programming to the letter, even if that means driving the entire market off a cliff. They don't understand context, nuance, or the real-world impact of their actions. They are incredibly powerful tools, but they are also incredibly dumb in a very specific way. This combination of immense power and zero wisdom is a recipe for disaster, and the flash crash was our first major warning shot. So, faced with the prospect of robot-induced financial Armageddon, what are we doing about it? Well, governments, particularly in Europe, are finally waking up and smelling the burnt server cables. Regulators are starting to realize that you can't just let powerful AI run wild in the most critical sector of our economy. The European Union is leading the charge with its landmark AI Act, a comprehensive set of rules designed to tame the digital frontier. The Act classifies AI systems by risk level, and you can bet your bottom dollar that algorithmic trading is being slapped with a high-risk label. This isn't just a gentle suggestion, it comes with serious teeth, including fines that could run into the billions. A key part of these new regulations is the push for what's called explainable AI, or XAI. This is a direct response to the black box problem. The idea is to force developers to build systems that can actually explain their decisions in a way that humans can understand. No more shrugging and blaming the magic 8-ball. Regulators want to be able to audit these algorithms to check for bias and ensure they are complying with the law. This, combined with mandates for stronger human oversight, meaning a real person has to be able to step in and pull the plug, is meant to put some guardrails on these incredibly powerful systems. We're trying to install an emergency brake on the runaway train. Of course, this is easier said than done. Technology is moving at a blistering pace, while regulation moves at the speed of a drowsy snail. By the time one set of rules is passed, a new generation of AI, perhaps involving quantum computing or decentralized finance, has already emerged with a whole new set of complex ethical problems. It's a constant game of catch-up. To keep up, regulators are exploring new tools like regulatory sandboxes, which are controlled environments where companies can test new AI technologies under the watchful eye of regulators before unleashing them on the public. It's a way to foster innovation without risking another flash crash. Ultimately, the goal is to build a future where financial AI works for everyone, not just a handful of high-frequency trading firms. Technology is a tool, and its impact depends entirely on how we choose to wield it. Without careful regulation, strong ethical guidelines, and meaningful human involvement, we risk creating a financial system that is not only unfair and opaque, but also dangerously unstable. The challenge is to strike the right balance, ensuring that we harness the incredible power of AI for good while keeping its potential for harm firmly in check. We need to make sure the robots work for us, not the other way around.